The year is 2026, and the commercial real estate market is telling two stories at the same time. On the surface, parts of the system look healthy, even strong. Trophy office towers in New York, London, Tokyo, and Singapore are posting record rents. Vacancy in the best buildings is tight. Capital still flows to assets that signal safety, prestige, and compliance with the new rules of work and sustainability. To a casual observer, this looks like resilience. Underneath that surface, however, the structure is cracking. What we are witnessing is not a typical property downturn driven by weak demand alone. It is a systemic fracture caused by the collision of three forces arriving simultaneously: a permanent shift in how companies use offices, a historic wall of debt maturing all at once, and a banking system that has quietly postponed loss recognition to avoid panic. These forces do not move independently. They reinforce one another, tightening into a feedback loop that turns localized stress into system-wide risk. The defining feature of the 2026 landscape is bifurcation. The office market is no longer one market. It has split into two economies that barely interact. On one side are prime, modern, ESG-compliant buildings in global financial centers. On the other is a vast inventory of aging, functionally obsolete stock that no longer fits how corporations work or how regulators think buildings should operate. This split explains why so much commentary about commercial real estate feels contradictory. Analysts can point to falling vacancy and rising rents in Midtown Manhattan or the West End of London and declare stabilization. At the same time, lenders are quietly modifying loans, capitalizing unpaid interest, and rolling maturities forward because large portions of the market are mathematically insolvent. Both observations are true. They describe different halves of a broken system. To understand why this fracture has become so dangerous in 2026, we have to start with how corporate behavior changed after the pandemic and never fully reverted. Office utilization never returned to pre-2020 norms. Despite years of executive mandates and cultural pressure, global utilization rates have stalled barely above 50%. Companies discovered that they could operate, grow, and compete without filling buildings 5 days a week. That realization permanently altered the logic of long-term leasing. A 10 or 15-year fixed lease made sense when headcount and location were predictable. In a world of hybrid work, rapid market entry, and constant capital reallocation, it became a liability. Out of that realization emerged what researchers now call the elastic portfolio. Corporations began treating real estate less like a static asset and more like a service layer. Space needed to expand and contract quickly. Leases needed flexibility. Offices needed to justify their existence by offering something homes could not: collaboration, culture, status, and experience. This shift favored landlords with scale, capital, and operational sophistication. Managing an elastic portfolio requires buildings that feel more like hospitality venues than storage for desks. It also requires balance sheets strong enough to absorb volatility. Smaller owners of older buildings simply could not make the transition. Their assets were designed for a different era of work and a different cost of capital. That is where the flight to quality accelerated into something closer to a K-shaped recovery. Talent concentration and sustainability regulation became the two dominant sorting mechanisms. Companies competing for high-end talent gravitated toward the best buildings in the best locations. Regulators, particularly in Europe and increasingly in North America, imposed decarbonization standards that rendered many older offices non-compliant without massive retrofits. The result was scarcity at the top and abandonment everywhere else. In London, the vacancy rate for new, high-quality buildings collapsed to barely more than 1%. In Tokyo, it fell below 1% entirely. In Midtown Manhattan, new supply dried up as financing costs killed development pipelines. Rents rose not because offices were universally healthy, but because the subset that still mattered became rare. At the same time, secondary assets entered a slow-motion collapse. Buildings that could not attract tenants at any price lost relevance. Their income declined, their values fell, and their debt structures began to fail. This did not immediately trigger a crisis, because most of that debt was not marked to market. It sat on bank balance sheets at historical cost, protected by accounting rules and regulatory forbearance. For several years, the industry survived on optimism and delay. Borrowers hoped rates would fall quickly. Lenders hoped demand would rebound. Everyone hoped time would solve a problem that was fundamentally structural. That hope acquired a name: survive until 25. By 2026, that slogan has expired. What makes this moment uniquely dangerous is the scale and timing of the debt maturity wall. More than $1.5 trillion of commercial real estate loans are scheduled to mature by the end of the year. These loans were originated in a world of 3% interest rates and peak valuations. They are now coming due in a world where refinancing costs are structurally higher and asset values, especially for offices, are down 20 to 40%. This is not a liquidity problem, it is a solvency problem. Many borrowers cannot refinance even if credit is available. Loan-to-value ratios no longer work. Debt service coverage ratios fail when interest costs double. Equity injections large enough to fix the math are often larger than the remaining equity value itself. In that environment, default is not a choice. It is an outcome. The reason defaults have not already cascaded through the system lies in the banking response. Regional and community banks, which hold a disproportionate share of commercial real estate loans, have used time as a tool. Through maturity extensions, interest capitalization, and careful classification, they have kept troubled loans technically performing. Losses exist, but they remain unrealized. This strategy stabilized the system temporarily. It also concentrated risk. As 2026 unfolds, the market is discovering that you can defer recognition, but you cannot defer reality. The collision between structurally obsolete buildings, unrefinanceable debt, and a banking system built on delayed acknowledgement is no longer theoretical. It is becoming mechanical, and once the mechanics start moving, they do not stop on command. The stress created by that collision does not distribute evenly. It accumulates in the weakest links first, and in 2026, those links are regional banks. Unlike global systemically important banks, regional lenders built their franchises around relationship lending and local markets. Commercial real estate was not a side business, it was the business. In many institutions, CRE loans make up a third or more of total assets. That concentration worked beautifully in an era of rising values and cheap refinancing. It becomes existential when values fall and refinancing fails. To understand why this matters systemically, it helps to be precise about how losses are being concealed. Extend and pretend sounds casual, almost cynical, but it is a deliberate financial engineering process. When a borrower cannot meet a maturity or a payment, the bank modifies the loan. The key is how that modification is structured. If the borrower is technically current, even if only because the bank advanced new funds to cover interest, the loan avoids being classified as troubled. Once it avoids that label, the bank avoids provisioning capital against it. In more severe cases, interest is capitalized. The borrower stops paying cash interest entirely. The unpaid interest is added to the loan balance. On paper, the asset grows. In reality, the borrower is insolvent and the collateral is deteriorating. This is not fraud. It is permitted by accounting standards and tolerated by regulators because the alternative is immediate recognition of losses that would wipe out equity at hundreds of institutions. The second layer of concealment is accounting classification. Loans and securities designated as held to maturity are carried at amortized cost, not market value. That distinction is critical. Market value reflects what someone would actually pay for the asset today. Amortized cost reflects what the asset was worth when it was originated, adjusted slowly over time. When rates rise and values fall, the gap between those two numbers becomes enormous. By 2026, that gap across the banking system is measured in trillions. It represents losses that exist economically, but not yet legally. As long as banks are not forced to sell assets, those losses remain theoretical. The entire strategy depends on one assumption: liquidity will always be available. That assumption is where the system becomes fragile. The common narrative is that the next shock will come directly from property defaults. An office owner hands the keys to the bank takes a loss, and the damage spreads. That is too simplistic. The more dangerous path runs through liquidity, not credit, and it begins outside the traditional banking system. Large real estate investment trusts occupy an awkward space in modern finance. They are not banks, but they operate with bank-like leverage. They do not take deposits, but they rely on constant access to short-term funding. Their business model assumes that capital markets will always be open enough to refinance bonds and roll debt. When that assumption fails, they fall back on their last line of defense: committed credit lines from major banks. These credit lines are legally binding. When a REIT draws on them, the bank must provide cash. In normal times, this is a formality. In stress, it becomes a transmission mechanism. Imagine a large office-focused REIT in mid-2026. Its portfolio is weighted toward older buildings in markets that never fully recovered. Cash flow is thin but manageable. A multi-billion-dollar bond maturity approaches. The REIT expects to refinance, as it has many times before. But the bond market demands yields that reflect reality, not hope. At 12%, the refinancing would destroy cash flow. The deal dies. At that moment, the REIT does what it is rationally required to do. It draws down its revolving credit lines. Those lines are syndicated among the largest banks in the world. One drawdown is manageable. The problem is correlation. As soon as one large REIT pulls liquidity, others pay attention. They know that banks under stress may reduce or cancel lines in the future. So they draw preemptively. What looks like prudence at the individual level becomes panic at the system level. Within days, hundreds of billions of dollars of committed credit can be converted into immediate cash demands. This is the moment when the shadow banking system touches the feet of the formal banking system. Risk that was thought to be dispersed and manageable suddenly concentrates on the balance sheets of the largest institutions. Liquidity ratios tighten. Cash becomes precious. Preservation replaces expansion. The reaction is predictable. Global banks pull back from interbank lending. They reduce repo exposure. They hoard liquidity to protect themselves. From their perspective, this is rational defense. From the system's perspective, it is starvation. Regional banks live on wholesale funding. They rely on larger institutions for liquidity backstops, repo markets, and correspondent services. When those channels constrict, regional banks feel it immediately. Depositors, especially uninsured ones, notice the stress. They remember recent history. Withdrawals accelerate. At that point, the accounting fiction collapses. A regional bank facing withdrawals must raise cash. To do that, it must sell assets. When it tries to sell a portfolio of performing commercial real estate loans, the market bids 60 cents on the dollar. The unrealized loss becomes realized. Equity evaporates. The revelation does not stay contained. Other banks with similar portfolios face the same questions. Depositors do not wait for answers. They run first. What began as a refinancing failure at a REIT becomes a systemic liquidity crisis rooted in asset quality that everyone pretended was manageable. This is the domino scenario that makes 2026 different from earlier stress episodes. It is not driven by exotic derivatives or opaque leverage. It is driven by ordinary assets valued under extraordinary assumptions, offices that no longer work, loans that no longer refinance, banks that no longer trust one another. The irony is that parts of the real estate market will look healthy even as this unfolds. Prime rents will hold, trophy buildings will remain full. Capital will continue to chase perceived safety. That contrast will confuse observers and delay response. The system will appear stable right up until liquidity disappears. What makes this moment unavoidable is that time, the tool used to defer pain, has run out. Maturities cannot be extended indefinitely without destroying credibility. Interest cannot be capitalized forever without inflating losses. Eventually, someone must recognize reality. When that happens, the damage will not be evenly distributed. Owners of obsolete buildings will lose equity entirely. Regional banks will consolidate or fail. Global banks will survive, but only by withdrawing from risk-taking. Credit will contract. Vacancies will rise further. Asset values will fall again, reinforcing the cycle. And yet, this is not the end of the system. It is the end of a cycle built on mispriced risk and deferred accountability. The clearing process will be painful, but it will also reset the market. Capital will re-enter at prices that make sense. Assets that can be repurposed will find new lives. Those that cannot will be written off. The question is not whether the fracture will widen in 2026. It is how cleanly the system allows it to break, and how quickly it learns from the shape of the damage. Once the system moves into that clearing phase, incentives change rapidly. Participants who survived by delaying recognition suddenly find that delay is no longer rewarded. Capital flows towards certainty, not optimism. The market stops asking what an asset used to be worth and starts asking what it can realistically become. This is where the narrative around opportunity in distress often becomes distorted. It is tempting to frame the post-crisis environment as a simple buying opportunity, a repeat of 2009 where patience alone produced outsized returns. That framing ignores how different the underlying problem is. In 2026, the issue is not cyclical oversupply or temporary demand destruction. It is functional obsolescence layered on top of excessive leverage. For investors, that distinction matters. Many office buildings will not recover, no matter how low the price. Their layouts do not support modern work patterns. Their energy profiles do not meet regulatory standards. Their locations no longer align with talent flows. Buying them cheaply does not make them viable. It only transfers the cost of adaptation to the new owner. The assets that will attract capital are those with a credible path forward. In some cases, that path is conversion. Residential reuse, mixed-use redevelopment, and integration with logistics or life sciences are all being explored aggressively. These projects are complex, expensive, and politically sensitive. They require cooperation between private capital and local governments. They also take time. During that time, cash flow is negative, not positive. In other cases, the opportunity lies not in owning buildings at all, but in owning the capital structure above them. This is where private credit enters the story. As banks retreat to repair balance sheets, private debt funds step in to fill the vacuum. They offer refinancing at high yields, often with tight covenants and control rights. The stated goal is income. The unstated option is ownership. Loan strategies thrive in environments like 2026. The borrower cannot refinance conventionally. Equity is already impaired. The lender structures the deal knowing that default is likely and acceptable. When it happens, the lender becomes the owner at a basis that reflects reality, not peak valuations. This is efficient capital allocation, but it is also ruthless. It accelerates the transfer of assets from overleveraged owners to well-capitalized ones. At the same time, occupiers are adapting in their own way. The experience portfolio is not a buzzword. It is a rational response to scarcity and competition. When only a narrow band of buildings truly works, companies concentrate their spend there. They invest in technology, sustainability, and amenities that reinforce productivity and identity. Offices become fewer, better, and more intentional. This creates a paradox. Total square footage demand declines, yet demand for the best space intensifies. That tension supports rents at the top, even as the broader market weakens. It also reinforces the bifurcation that makes aggregate statistics misleading. Average vacancy rates tell you very little about risk when the distribution is so uneven. Policy responses will attempt to smooth this transition, but they cannot eliminate it. Regulators will face pressure to relax capital requirements, extend forbearance, and support banks deemed systemically important at the local level. Some of that will happen. It always does. The objective will be to slow the pace of failure, not to prevent it entirely. Municipal governments will also be drawn in. Office vacancies translate directly into falling tax revenues and visible urban decay. Adaptive reuse incentives, zoning changes, and tax abatements will proliferate. These measures can help at the margin, but they do not solve the capital mismatch. Converting an office tower is expensive. Incentives rarely cover the full gap between what the building is worth today and what it must become to be viable. The deeper lesson of 2026 is about leverage and time. For years, cheap money allowed the system to confuse duration with safety. If you could roll debt cheaply, the underlying cash flow did not need to be robust. Risk was not eliminated, it was deferred. The maturity wall forces that deferral to end. Banking, at its core, is a confidence business. Confidence rests on transparency and liquidity. When assets are opaque and liquidity is assumed rather than ensured, confidence becomes fragile. The events of 2026 expose how much of the system relied on accounting treatments and optimistic assumptions to maintain that confidence. Once the market internalizes this, behavior changes across sectors. Lenders demand higher equity buffers. Borrowers accept shorter durations or higher costs. Development slows, not just because financing is expensive, but because uncertainty is high. This slows economic activity in the short term. It also reduces the probability of repeating the same mistake at scale. From a macro perspective, the commercial real estate fracture feeds into broader economic dynamics. Credit contraction affects small and mid-sized businesses first. These firms rely on regional banks for working capital, expansion loans, and real estate financing. When those banks pull back or fail, investment slows. Employment growth weakens. Office demand softens further, reinforcing the cycle. This is why the crisis cannot be viewed in isolation. It is not about buildings alone. It is about how financial structures amplify structural change. Remote work did not just reduce office demand. It interacted with leverage, regulation, and banking incentives in a way that transformed a shift in behavior into a systemic risk. By late 2026, the outlines of the new equilibrium will begin to emerge. There will be fewer banks, larger and more conservative. There will be fewer office buildings, but those that remain will be higher quality and more intensively used. Capital will be more expensive and more selective. Growth will be slower, but also less dependent on hidden leverage. This is not a story of collapse followed by immediate recovery. It is a story of repricing followed by adaptation. Systems that depended on denial will fail. Systems that adapt to constraints will survive. The year will be remembered not for a single spectacular default, but for a quiet realization that the old rules no longer applied. When the bill came due, it was not paid all at once. It was paid through consolidation, write-downs, and a redefinition of what commercial real estate is meant to do. In that sense, 2026 marks the end of an era that began with cheap capital and unquestioned growth. What replaces it will be less forgiving, but more honest. And in macro, financial systems, honesty, however painful, is the foundation of stability. To see why this transition matters beyond real estate, it helps to step back and look at the incentive architecture that produced the crisis in the first place. For more than a decade, the system rewarded balance sheet expansion over balance sheet resilience. Cheap capital lowered the apparent cost of mistakes. Duration substituted for discipline. When refinancing was always available, underwriting standards softened because the penalty for being wrong was theoretical, not immediate. Commercial real estate became one of the cleanest expressions of that logic. Long-lived assets financed with short and medium-term debt created the illusion of stability as long as markets remained liquid. Rising values masked weak cash flows. Accounting conventions smoothed volatility. Regulators, wary of triggering crises, accepted gradualism as prudence. Each individual decision made sense locally. Collectively, they produced fragility. What 2026 exposes is the cost of synchrony. Risk that looks manageable when maturities are staggered becomes dangerous when they cluster. The maturity wall is not just a large number, it is a coordination problem. Too many borrowers need capital at the same time, and too many lenders face the same constraints at once. In that environment, price discovery becomes abrupt. There is no gradual adjustment, there is repricing. This repricing forces a reassessment of what banks are for. The pre-crisis model positioned regional banks as engines of local growth, intermediating savings into productive investment. Their heavy exposure to commercial real estate was justified by familiarity and historical performance. In practice, that concentration tied their fate to a single asset class, whose economics changed faster than their balance sheets could adapt. As consolidation accelerates, the banking landscape shifts toward fewer, larger institutions with more diversified exposures. That may reduce idiosyncratic risk, but it also concentrates power and decision-making. Credit allocation becomes more standardized, more risk-averse, and less responsive to local nuance. Small businesses and transitional projects struggle to access financing. The economy becomes safer at the core and more brittle at the edges. Risk that looks manageable when maturities are staggered becomes dangerous when they cluster advanced economies. Lower trend growth combined with higher perceived stability. Systems optimize for survival rather than expansion. Innovation does not disappear, but it migrates toward sectors with clearer scalability and shorter feedback loops. Real estate, with its long timelines and regulatory complexity, becomes a secondary concern. Yet cities cannot simply abandon their physical infrastructure. Offices do not vanish when they become obsolete. They sit empty, imposing costs on municipalities and communities. The political response to this reality is already forming. Urban policymakers increasingly frame office conversion not as a market opportunity, but as a social necessity. Housing shortages, climate goals, and fiscal pressures converge on the same solution: reuse. Whether reuse succeeds at scale remains uncertain. Structural constraints limit what can be converted efficiently. Floor plates, window placement, plumbing, and zoning all matter. Financially, the gap between acquisition cost, conversion cost, and post-conversion value remains wide in many markets. That gap must be filled by some combination of private capital, public subsidy, or loss acceptance. Each option carries trade-offs. For investors, this environment demands a different mindset. Passive appreciation is no longer a strategy. Leverage magnifies downside more than upside. Returns come from problem-solving rather than patience. The winners are not those who predict a rebound in office demand, but those who correctly identify which assets can be repositioned and which must be written off entirely. The same logic applies at the system level. Policymakers face a choice between prolonging adjustment through continued forbearance or accelerating it through transparency. Prolongation reduces short-term pain but increases long-term uncertainty. Acceleration concentrates pain but clears the path forward. History suggests that systems eventually choose clearing, often after exhausting denial. As the clearing progresses, narratives will compete. Some will frame the crisis as a failure of work, from home culture, arguing that demand would return if only behavior changed. Others will blame regulation, interest rates, or banks. These narratives obscure the more uncomfortable truth. The crisis is the result of incentives that encouraged leverage without sufficient regard for adaptability. Work patterns changed because technology allowed them to. Regulation tightened because climate risk became unavoidable. Interest rates rose because inflation exposed the cost of monetary excess. None of these forces are anomalies. They are structural responses to deeper shifts. Commercial real estate happened to sit at their intersection. By the end of the decade, the office sector will be smaller, more concentrated, and more specialized. It will play a different role in corporate life, one centered on coordination rather than routine. The banking sector will be more conservative, less tolerant of asset liability mismatches, and more skeptical of long-duration risk. These changes will feel restrictive compared to the past. They will also be stabilizing. From a macro-financial perspective, the 2026 episode functions as a stress test that revealed where assumptions diverged from reality. It showed how accounting frameworks can delay recognition but not eliminate loss. It demonstrated how liquidity, not solvency, often determines the timing of crises. And it highlighted how interconnected systems transmit shocks in unexpected ways, from rates to global banks to local lenders. Most importantly, it marked the end of an era in which commercial real estate was treated as a low-volatility asset class by default. That classification shaped capital allocation for decades. Its reversal forces a repricing not just of buildings, but of risk itself. The lesson is not that real estate is inherently dangerous. It is that no asset class is safe when its economics change faster than its financing structures. Stability depends less on what you own than on how you fund it, and how quickly you can adapt when conditions shift. As the dust settles, the system will look calmer on the surface, vacancy rates will stabilize, banks will report healthier balance sheets. New projects will proceed cautiously. Underneath that calm will be a memory of fragility that tempers exuberance. That memory may be the most valuable outcome of the 2026 crisis. It will not prevent future cycles, but it will shape how risk is priced and how leverage is used. In a financial system prone to forgetting, moments like this serve as hard reminders. When historians look back, they may not point to a single failure or a dramatic collapse. They will point to a year when assumptions were revised en masse. When the maturity wall forced recognition. When the office market stopped pretending it was homogeneous. And when the banking system relearned, at considerable cost, that liquidity is not a given, but a condition that must be earned. The crisis, in that sense, will not end with a headline. It will end when behavior changes. The change in behavior is already visible by the time the system reaches late 2026. It does not arrive as a sudden declaration or a coordinated reform. It shows up in quieter signals. Loan committees reject deals that would have sailed through a few years earlier. Appraisers apply harsher assumptions and defend them. Equity investors demand control provisions rather than upside stories. Risk managers gain influence over originators. None of this feels dramatic, but together it marks a regime shift. In this new regime, the concept of a normalized evaluations loses meaning. For years, normalization meant a return to pre-crisis pricing once volatility passed. After 2026, normalization means something else. Alignment between cash flow durability, asset flexibility, and capital structure. Buildings are valued not for what they represented historically, but for how well they can function under multiple future states of work. Regulation. and capital costs. That shift is particularly evident in how investors think about duration. Long-duration assets financed with short-duration liabilities are no longer treated as routine, they are treated as fragile. Duration mismatch becomes a primary risk metric rather than a footnote. This reorientation ripples outward, affecting infrastructure, private credit, and even government finance. Commercial real estate is simply where the lesson is learned most visibly. The office sector, once a symbol of institutional stability, becomes a case study in adaptive failure and adaptive success. Some owners manage to recapitalize early, accept dilution, and reposition assets before liquidity disappears. Others delay, hoping for a reversal that never comes, and are forced into distressed outcomes. The difference is not intelligence or effort. It is timing and willingness to recognize loss. From a systemic standpoint, this distinction matters because it determines how disorderly the adjustment becomes. Early recognition spreads losses across stakeholders. Late recognition concentrates them at the point of failure. The banking system, having experienced both paths in quick succession, becomes structurally biased toward earlier intervention. That bias reduces upside in booms, but it also reduces tail risk. The same logic applies to policymakers. After years of relying on forbearance as a stabilizing tool, regulators confront its limits. Forbearance works when shocks are temporary and fundamentals intact. It fails when shocks reveal permanent change. In 2026, regulators learn that delaying recognition in the face of obsolescence does not preserve value. It redistributes losses in less transparent ways. This realization does not eliminate intervention. It reframes it. Support shifts from protecting legacy valuations to facilitating transition. Incentives target conversion rather than preservation. Capital relief is paired with restructuring rather than extension. The goal becomes system functionality, not asset defense. For cities, this reframing is existential. Urban cores built around dense office employment must redefine their economic logic. Mixed-use development moves from a planning aspiration to a fiscal necessity. Residential, cultural, and service uses fill gaps left by shrinking office demand. This process is uneven and politically contentious, but it reflects a deeper truth. Cities are adaptive systems, not fixed machines. At the macro level, the commercial real estate adjustment contributes to a broader recalibration of growth expectations. Credit becomes scarcer and more expensive. Investment decisions carry higher hurdle rates. Leverage retreats from its post-crisis extremes. These shifts dampen cyclical expansion, but they also reduce the frequency of destabilizing bubbles. Growth slows, but it becomes less dependent on fragile financing structures. In that environment, narratives of decline compete with narratives of discipline. To some, the post-2026 world feels constrained, cautious, and less dynamic. To others, it feels more grounded. Both perceptions are accurate. Financial systems trade speed for stability, risk taking for resilience. Neither state is permanent, they oscillate. The difference is that after 2026, the memory of fragility lingers longer. The commercial real estate crisis does not end because vacancy rates improve or refinancing markets reopen, unless dynamic expectations reset. When lenders assume that not all assets deserve refinancing, when investors assume that equity can be permanently impaired, when policymakers accept that not every legacy structure can be saved without cost. That acceptance is the true clearing mechanism. It allows capital to flow again, not indiscriminately, but purposefully. It allows cities to plan around realistic uses rather than nostalgic ones. It allows banks to lend without relying on accounting to mask risk. Looking back, the defining feature of the 2026 episode is not the size of the losses, large as they are. It is the way those losses reveal the architecture of the system. They show where incentives aligned and where they did not. They show how interconnected modern finance has become, and how quickly liquidity can transform localized stress into systemic threat. The commercial real estate maturity crisis is, in that sense, a mirror. It reflects the consequences of a decade spent optimizing for cheap capital and smooth narratives. When the mirror cracked, it did not create new weaknesses. It exposed existing ones. By the time the dust settles, the sector is smaller, the banks fewer, and the rules stricter, but the system is also more coherent. Risk is priced closer to reality, duration is treated with respect, and the idea that time alone can solve structural problems loses credibility. That is why 2026 will be remembered not just as a year of defaults, but as a year of recognition. The moment when the industry stopped surviving until the next date on the calendar and started operating within the constraints that had always been there. The bill came due, and it was paid not all at once, not without pain, but with a finality that closed one chapter and opened another.